Okay, let's unpack this. If you're following the world of finance, you see headlines about earnings reports, stock movements, all the time.
Hmm.
But to really understand what drives a massive global firm, you kind of need to look beyond just the quarterly numbers.
Right.
The annual shareholder letter, the one penned by the CEO,
Yeah,
it's way more than just a financial recap.
absolutely. It's like their strategic blueprint, a cultural statement, a really revealing look at how leadership views the challenges, the opportunities ahead.
Yeah, it's like a window you can peek through to get uh, genuinely well-informed.
Exactly. Think of it like the leadership team laying out their story for the year, explaining why things happened and where they plan to go next. It gives you that crucial context the headlines often miss.
And that's precisely what we're diving into today. We're taking a close look at the Goldman Sachs 2017 shareholder letter.
Hmm.
And this isn't just about, a big bank's performance. It's about understanding the strategic moves, the outlook of a major player in the global financial world during a really specific period of, economic and regulatory change. For you, someone tracking this space, documents like this offer just invaluable insights.
Our source material today comes directly from excerpts of that 2017 letter. This was written by the chairman and CEO at the time, Lloyd C. Blankfein.
Okay.
And we'll also use a set of structured questions, sort of like a compass, to help guide us through the key areas the letter touches on.
Right. So our mission is pretty straightforward. Pull out the most important insights, really grasp the core themes, and understand what this moment in time meant for Goldman Sachs using only the source material we have.
Hmm.
And we know from the letter itself that 2017 was a year that involved significant planning. There was that key leadership transition mentioned where David M. Solomon was getting ready to take on sole responsibility as president and COO.
Right, following Harvey Schwartz's retirement.
Exactly.
And, the tone of a shareholder letter is always important. It's really carefully crafted to communicate confidence, strategic direction, especially to investors. Blankfein's letter sets a scene of navigating these shifting markets and regulations while, focusing really intently on growth and efficiency.
So let's just jump right into it then. What did the letter actually report about Goldman Sachs' overall financial performance back in 2017? What were those top-line numbers that set the stage?
Okay, so the headline figure they reported was net revenues of $32.1 billion for 2017.
$32.1 billion. Okay.
And that was actually a 5% increase compared to their 2016 results.
5% increase sounds, pretty good. But 2017 also brought that major U.S. tax reform. That must have had a big impact, right?
Oh, a massive one-time impact, yeah. The letter specifically calls out a $4.4 billion estimated income tax expense.
Wow.
Directly related to that new U.S. tax legislation. And this significantly skewed their reported results compared to what you might call their, underlying operating performance.
And the difference those numbers made is pretty stark. Looking at the reported figures, including that $4.4 billion tax hit, net earnings applicable to common shareholders were $3.7 billion.
Right.
Their diluted EPS, that's earnings per share, came in at $9.01. The reported return on equity, the ROE, was only 4.9%.
Okay, but now, if you look at those same numbers, excluding that one-time tax expense,
Right. The adjusted view?
the picture changes, dramatically. Net earnings would have been $8.1 billion. Diluted EPS jumps up to 19.76 cents.
Big difference.
And the adjusted ROE was 10.8%. And, that 10.8% figure is what they really emphasize as reflecting the year's performance, absent that big tax change.
And they put that 10.8% ROE on context, too, didn't they?
Yeah.
Mentioning it was double-digit ROE in 5 out of the last 6 years.
Exactly. With the one outlier year hitting 9.4%, it really underscores their stated focus and intensity on achieving strong shareholder returns.
Right.
They manage expenses, strategy with those returns really firmly in mind, even if, market conditions mean double digits aren't guaranteed every single year.
Sure.
Right. And the letter attributes this ability to perform, even with that tax hit, to the diversity of their business mix. They said 3 out of their 4 main segments showed solid growth in 2017.
Okay. Speaking of conditions, what was the general market and economic backdrop the letter describes for 2017?
Yeah.
How did they see the world then?
Well, they paint a picture of a global economy that was generally expanding throughout most of the year. This reflected growth picking up in both developed and emerging markets.
Did they point to any specific regions doing particularly well?
Yeah, they did. They mentioned the U.S. recovery continuing with an improving labor market, the euro area strengthening, although inflation was still pretty subdued,
Hmm.
and solid growth in Asia, particularly Japan getting a boost from exports, and China showing robust growth.
Now, here's where it gets really interesting for understanding their kind of strategic thinking. The letter identifies several major inflection points they were watching or maybe even experiencing in 2017. What were these big shifts they saw?
Okay, the first major inflection point they identified was the global economy moving from a period of, generally lower growth
Right.
into an environment with stronger global growth and, importantly, tighter labor markets. That fundamentally changes the operating environment for their clients.
Sure, yeah. And the second shift,
The second one was about central banks. They were starting to move away from those extraordinarily easy monetary policies that were put in place after the crisis.
right, the QE era.
Exactly, moving towards more normal approaches. And they actually note that the prior easy policy had kind of dampened market volatility.
Ah, okay, so that second point links directly back to those market-making businesses you mentioned earlier, where low volatility was a headwind for them.
Precisely. It highlights how, macroeconomic policy directly impacts specific business lines.
Okay, so what was the third inflection point they noted?
This one is pretty fascinating from a regulatory perspective. They perceived a potential transition moving away from an intense period of just increasing layers of regulation
Right, post-crisis buildup.
towards maybe a focus on rationalizing redundancies, assessing the costs and benefits of the existing rules. It sort of suggests they felt the big post-crisis regulatory surge might be cresting.
That's a really specific read on the regulatory climate at that time. Okay, so against this backdrop of change, economy, policy, regulation, they laid out a pretty clear strategic goal. This $5 billion net revenue growth plan over the next 3 years.
Yeah, and they were careful to specify this wasn't like the absolute ceiling for their ambition.
Yeah.
And notably, they structured it so it wasn't dependent on the operating environment improving, even though, as they said, conditions seemed more favorable at the time.
And what was underpinning that whole growth plan?
Technology. They stressed the critical importance of significant investments in engineering and tech. They basically called their long history of commitment to tech a competitive advantage.
Makes sense.
Crucial for enhancing the client experience, driving efficiency, driving scale.
Okay, so let's dig into how they actually plan to achieve that $5 billion growth across their key business areas. Maybe starting with investment banking.
Sure. They described investment banking as their preeminent global franchise. They highlighted that 2017 actually achieved its second highest net revenues since the firm's IPO back in 1999,
Wow.
driven by, their deep client relationships. And they point to their number one rankings in worldwide M&A, both announced and completed, and also in equity offerings as kind of evidence of that strength.
Okay, so if you're already number one in the big leagues, how do you plan to grow from there? What was the strategy?
Well, the strategy seemed focused on expanding their reach, particularly into areas where they saw untapped potential. They aimed to increase their coverage universe by about 1,000 companies.
1,000. Okay.
Yeah, targeting both private and public firms, but with a specific focus on smaller transactions, those under $5 billion, where, they historically had a lower market share compared to their dominance in the really big deals.
And they also looked at expanding their physical footprint too, right? Putting people on the ground in more places.
Exactly. They deployed more senior coverage bankers into major North American corporate hubs, places like Atlanta, Dallas, Seattle, Toronto.
Right.
Seeing this as a way to deepen relationships in these growing markets. And the letter actually notes this was already yielding results, bringing in over 75 new mandates from those efforts.
Okay. What about debt underwriting? That's often seen as a slightly different muscle than M&A or equity advisory.
Yeah, they highlighted success there too, stating it had been a strategic priority for about 5 years. And by 2017, it was generating nearly $3 billion in net revenue.
$3 billion.
Which was more than double their average from the, say, 2009-2011 period. So that shows a pretty deliberate build-out of capabilities there.
And given China's growing role in the global economy, did they specifically mention focusing there?
Yes, definitely. The letter notes their number one ranking in equity and equity-related offerings among the international banks operating in the region. So positioning them well to capture opportunities presented by China's economic significance.
Okay, so moving from that classic advisory business to institutional client services, or ICS, these are the more, let's say, dynamic businesses, often impacted directly by market volatility or the lack of it, as we discussed.
Right.
And within ICS, they cover FICC, that's fixed income, currency, and commodities and equities. Let's start with FICC. How did they talk about that?
They were actually quite candid here. They acknowledged that FICC performance in 2017 was weak relative to their commitment.
Okay, weak.
Yeah, and they put it in the broader industry context. FICC revenues across the whole industry were down significantly since the peak back in 2009, and Goldman, like others, had scaled back resources in response over those years.
So if performance was weak, why focus on it as a growth area in this plan? Seems counterintuitive.
Well, I think with the global economy looking like it was on firmer footing, they didn't want to miss potential upside, right?
Okay.
They state they had recently deployed more resources back into FICC, seeing attractive opportunities despite the, challenging environment. So it was a kind of strategic reinvestment after a period of pulling back.
And how were they trying to boost performance specifically? What was the plan?
They did a comprehensive review, apparently, and it revealed they'd historically focused really heavily on active investors and complex products, things like structured trades, derivative.
Right, the sophisticated stuff.
Exactly, and had perhaps underinvested in the simpler cash products like
Hmm.
plain vanilla bonds or currencies, the flow business.
Okay.
And this meant they had lower penetration with certain large clients like banks and asset managers who primarily trade those flow products.
So the response was basically to broaden that client coverage and really enhance the cash and flow trading capabilities.
Precisely. The plan was deepen relationships with those bank and asset manager clients, grow corporate coverage too, enhance those cash and flow capabilities, and hold teams accountable for being, top three with their key clients. They mentioned seeing early signs of market share gains from these efforts already.
And I assume leveraging technology here as well.
Oh, absolutely. Using their engineering capabilities for best execution, providing better content, analytics that was seen as key to differentiating themselves. That included consolidating automated pricing and risk management platforms too.
Okay. It sounds like a pretty significant strategic pivot within FICC, taking a recognized weak spot, giving it renewed investment, and kind of shifting the focus. How about the other side of ICS, equities?
Equities was described more as a multi-year investment story. They'd been investing in people, platforms, products for a while to grow what they saw as a leading franchise, both in execution, which is trading, and in financing.
And what specific tech investments stood out there? Anything mentioned?
Yeah, they highlighted some key strategic hires aimed at enhancing electronic execution. Things like a new chief data officer for the whole firm, a global head of electronic execution services, and a CTO specifically for electronic trading.
Okay, serious hires.
And in 2017 alone, they added about 100 people focused just on electronic execution, and over 70 of those were engineers.
Wow, that is a serious commitment to the digital side of trading.
Definitely. And they even bought technology platforms too, right?
He did.
Yeah, 2 years prior, they'd acquired this high-performance trading platform from a company called Panther Engineering, which they were in the process of rolling out. They were claiming their smart router technology was positioning them among the top 3 providers for accessing developed European markets.
And the letter mentioned some big partnership that kind of validated these efforts in equities.
Yes, a significant one. At the end of 2017, they announced they were becoming the exclusive execution provider for Bloomberg's Tradebook
Oh,
platform.
well, Bloomberg. Okay.
Yeah. They expected this would bring in over 1,300 new clients and generate a revenue run rate of over $100 million. This was highlighted as directly supporting their focus on serving those quantitative investors, the quants, who rely so heavily on electronic trading.
Okay, makes sense. Next up, investment management. This seems like a more stable, fee-based kind of business compared to trading.
It generally is, yes. They state the business is well-positioned because of its breadth, lots of asset classes, products, distribution channels. And in 2017, they saw pretty substantial inflows. $42 billion in long-term fee-based, or LTFB, net inflows.
$42 billion, that's significant.
It is because those LTFB revenues are generally more predictable than, say, trading revenues.
Sorry.
And over the previous 5 years, they'd consistently added assets totaling about $270 billion in LTFB net inflows during that period.
Who are the big clients driving these kinds of inflows?
Well, they note being a top provider to clients who are outsourcing their pension plan management and other assets. So acting as chief investment officer or advisor for over $110 billion there. They also manage or advise on another $190 billion for insurance clients, leveraging their analytics and risk management expertise for them.
And what about their private wealth management business, the part serving high net worth individuals?
That segment also showed strong LTFB net inflows, $17 billion in 2017, which is actually an increase from $12 billion in 2016.
Okay, good growth there.
Yeah, and they plan to grow their private wealth advisor population by approximately 30% through 2020, seeing significant growth potential there still.
They also highlighted a specific unit called ICO, right? What's that?
Right, ICO. It provides financial planning services to corporate clients and their executives. Now, while they covered 400 companies and 13,000 executives, they pointed out that was actually only 20% of the Fortune 1000.
So lots of room for expansion?
Exactly, indicating room to grow. And the letter mentions the launch of a new digital advisory service specifically for the employees of these ICO corporate clients. It was already live at over 70 companies by the end of 2017.
Interesting. So embracing digital delivery even in that sort of traditional wealth management space? Okay, let's move on to the next big area. Investing and lending. This is where they use their own balance sheet, their own capital.
Correct. This business provides capital either through loans or equity investments to companies and clients. And the growth here was really notable. Their funded loan portfolio reached $81 billion at the end of 2017,
$81 billion.
which was, get this, 3.5 times higher than it was at the end of 2012.
Wow, 3.5x. That significant loan growth must change their revenue profile quite a bit.
It does, exactly. By growing that loan portfolio, they increase their contribution from net interest income NII, which is basically the profit they make from lending versus what it costs them to get the funds.
Right.
And this makes the investing and lending net revenues more stable, more recurring than some other parts of the business. They actually entered 2018 with a $2 billion net interest income run rate.
Okay.
And NII in the fourth quarter of 2017 was up roughly 70% compared to the year before.
70% year over year. Wow. Where specifically was this lending growth coming from? Any key areas?
Yeah, a couple of key areas mentioned. They increased lending to their existing private wealth management clients. Funded loans there grew 15% year over year to about $24 billion in 2017,
Okay.
which in turn drove about a 30% increase in the related net revenues from those clients.
Nice synergy there.
And they also launched something called GS Select. This was a digital platform offering securities-based loans, but via third-party registered investment advisors, or RIAs, so connecting with large independent RIAs to offer loans to their clients.
Interesting channel. And what about institutional lending?
Institutional lending and financing was highlighted as a high-margin, high-return business, often leveraging their special situations group, focusing on middle-market companies.
Okay. The letter also emphasizes their merchant banking business, right? Investing their own capital in companies.
Yes, very much so. Described as a core part of their DNA, a source of strong risk-adjusted returns. They've been doing this for well over 30 years.
Long time.
Yeah. And since 2015 alone, they generated nearly $11 billion in net revenues just from their diversified equity investments, primarily from merchant banking. And they sourced over $40 billion in commitments since 2015 across both equity and credit merchant banking funds.
And didn't a specific initiative tied to China also appear in this section of the letter?
Yes, it did. They announced the Cooperation Fund. This was a partnership with the China Investment Corporation, the CIC.
Okay.
And the plan was to raise $5 billion to invest primarily in U.S. companies that were looking to expand their business within China.
Got it. So all these initiatives seem to leverage their traditional strengths, banking, trading, investing. But the letter also introduces something entirely new and potentially quite disruptive for them.
Yeah,
What's the digital consumer platform?
Yes, Marcus, by Goldman Sachs. This was their big foray into direct-to-consumer digital finance. The core idea was, addressing consumer pain points with simple, transparent, flexible products.
Yeah.
Launched originally with just personal loans, but the vision was always for a broader suite of products designed to be impactful for the firm's overall business.
But why enter the, pretty crowded consumer finance space? It seems like a departure.
Well, they clearly saw a major market opportunity. Consumers were moving away from physical bank branches, embracing technology more and more.
Sure.
And Goldman Sachs felt they were kind of uniquely positioned to be a disruptor here because they could leverage their balance sheet, their risk management expertise, their technology, but without the burden of legacy systems, old infrastructure, or, frankly, existing consumer businesses that traditional banks often have to protect.
Right, no cannibalization worries. They could build it fresh.
Exactly. Build it from scratch.
So what progress had Marcus actually made by the end of 2017, according to the letter?
They had originated $2.3 billion in personal loans by that point, but the letter notes they were growing deliberately, very focused on the credit cycle, and building a resilient loan book, which
Mhm.
is, crucial in consumer lending.
Absolutely. And how are they funding these loans? Where did the money come from?
Well, a key funding source was growing deposits through the Marcus platform itself. Those deposits grew by over $5 billion just in 2017,
Wow.
ending the year at $17.1 billion. That was almost double the balances they had when they first entered the deposit business back in April 2016.
That's pretty significant growth for a brand new platform, really.
It is, yeah. By the end of 2017, Marcus was serving over 350,000 customers, combining loans and deposits, and they clearly saw potential to scale that up to millions.
So what were the plans for Marcus looking forward from that point?
Well, the intention was definitely to expand more lending products, more savings products over time, both directly to consumers and also through partnerships. They saw longer-term opportunities for a much wider suite of consumer offerings. And the criteria for adding new products were pretty consistent. Had to be a large addressable market, something where they could leverage their expertise, offer potential for attractive shareholder returns, and, crucially, deliver solutions that were truly centered around the consumer.
Okay. So beyond all the business segments and the big strategy push, the letter places a really strong emphasis on their people and leadership, describing them as what the most important long-term competitive advantage.
Absolutely. They state they invest heavily in attracting, developing, and promoting professionals, seeing it as, foundational to their success.
And they mentioned some external recognition for their workplace environment, too.
Yes, they proudly noted their inclusion on Fortune's 100 Best Companies to Work For list every single year since 1984. Apparently one of only 4 companies to achieve that.
That's impressive consistency.
Yeah, and they were also recognized by Working Mother magazine's 100 Best Companies for 15 consecutive years, which earned them a place in that magazine's Hall of Fame.
Okay. What about the specifics of their hiring and talent pipeline? Any details there?
Well, in 2017, they hired over 6,000 people globally, and they highlighted a high acceptance rate. Over 8 out of 10 offers they made were accepted.
It's a good sign.
They also highlighted efforts to expand and diversify their applicant pool using tech like video interviewing and online coding challenges, which apparently allowed them to interview intern candidates from over 150 more schools for the 2018 class.
And given the increasing role of technology we talked about across all their businesses, that focus on STEM talent seems particularly relevant.
Very much so. The letter notes the growing importance of technology means a greater focus on hiring people with STEM backgrounds: science, technology, engineering, math.
Right.
About a quarter of the entire firm already worked in engineering roles back then, and over a third of their 2017 campus analyst hires were STEM majors, a percentage they expected to keep rising.
And what about leadership development within the firm? Promoting from within.
Yeah, they discussed their newest class of managing directors, 509 total, and they broke down the diversity. 24% were women, regionally 25% from EMEA, 57% Americas, 18% Asia.
Okay.
But a key point they highlighted was that 66%, 2/3 of this new MD class, actually started at the firm as analysts or associates.
Showing that internal pipeline.
Exactly, underscoring their commitment to internal talent development and retention.
The letter also addresses leadership succession, specifically that planned transition right at the very top.
Yes, Lloyd Blankfein discusses his role in ensuring smooth transitions. And with the announced retirement of Harvey Schwartz as president and co-COO,
Right.
David Solomon was set to assume sole responsibility for those roles, president and COO.
And the letter included quite a tribute to Harvey Schwartz and his impact on the firm, didn't it?
It did. It details his 20-year career, his significant leadership roles overseeing growth in the securities division, playing a crucial role in managing risk during the financial crisis, being instrumental in adapting the firm to regulatory changes when he was CFO. Blankfein praises his deep commitment, work ethic, command of complexity, client focus, and his influence on developing other leaders, and, thanked him very sincerely for his service.
Okay, so moving from the internal focus on people to their external impact, the letter discusses corporate responsibility.
Yeah.
How do they frame this? What's their approach?
Well, they state that embracing responsibility to address environmental, social, and economic challenges is really integral to their mission, both through their core business activities, but also by leveraging their expertise in other ways. The aim, they say, is to be active corporate citizens driving positive change.
And what specific programs did they showcase as examples?
They highlight their flagship programs like 10,000 Women and 10,000 Small Businesses, which are focused on helping entrepreneurs succeed.
Right. Heard of those.
Yeah. They mentioned the upcoming 2018 summit for 10,000 small businesses in Washington, D.C., described it as potentially the largest gathering of small business owners ever in the U.S. Over 2,000 owners come together to discuss strategy, policy, and advocate on Capitol Hill.
And what about the firm's direct philanthropic efforts? Through Goldman Sachs Gives.
Right, that's their donor advised fund, primarily for participating managing directors. Since it launched back in 2010, it had directed over $1.3 billion in grants by the end of 2017
$1.3 billion.
to about 6,000 different organizations. Its mission is described as fostering innovative ideas, solving economic and social issues, and supporting progress in underserved communities.
And examples mentioned?
Yeah, they mentioned the Analyst Impact Fund competition, which sounds interesting, and also specific grants and volunteering efforts for disaster relief, like for the hurricanes Harvey, Irma, Maria, and the earthquakes in Mexico that happened in 2017. That totaled over $2 million in grants and involved over 1,000 employee volunteers.
Okay. And they also have a specific investment arm that focuses on underserved areas, right?
Yes, the Urban Investment Group, or UIG. Since 2001, UIG had committed over $6 billion specifically to underserved U.S. communities by the end of 2017.
$6 billion?
And this investment facilitated the creation or preservation of over 25,000 housing units, with over half designated as affordable, plus millions of square feet of community space, commercial space, retail, industrial.
Was there a specific project example given for UIG in the letter?
Yes, they highlighted the Essex Crossing development on the Lower East Side of Manhattan in New York City.
Oh, okay.
Goldman Sachs committed nearly $500 million to this really large mixed-use project. It was being built on a site that had actually been vacant for almost 50 years.
Wow.
Yeah. It includes over 1,000 apartments, again, with more than half designated as affordable, and nearly 1 million square feet of commercial and community space. So the UIG's mission is framed as achieving both positive impact in underserved areas and generating a good financial return.
Right, the double bottom line idea. Okay, finally, let's look at how the letter wraps up. How did they look ahead from their perspective in early 2018?
Well, at that specific moment, they viewed conditions as highly supportive. A growing global economy, relatively low interest rates given where they were in the economic cycle.
But being Goldman Sachs, as risk managers, they're always looking for potential downsides, I assume.
Oh, absolutely. They explicitly state they are preparing for, quote, low probability, high consequence events.
Right, the black swan.
Exactly. They were mindful that with the U.S. near full employment, inflation low, and the end of quantitative easing happening, there was an increased chance of, excesses building up somewhere in the system. So they emphasize keeping a very close eye on risk, particularly within the credit cycle.
And they acknowledge the inherent unpredictability of the markets they operate in, too.
Yes, stating quite clearly that cycles turn, markets change quickly, and often in response to factors that, no one can predict with certainty.
Sure, despite those acknowledged risks and uncertainties, what was the overall sentiment conveyed about Goldman Sachs's future at the end of the letter?
Well, they remained optimistic and confident in their ability to grow. And this confidence stemmed from several things. Their strong client franchise, their ongoing execution of those growth initiatives we talked about, and the continued investments across the firm.
Okay.
But they reiterate that generating strong relative returns and value for shareholders ultimately relies on the hard work, the commitment, the collaboration of their people.
Right, back to the people point.
Yeah.
Okay, so you've now had a pretty deep dive into a major financial institution's strategic thinking from back in 2017, pulling insights directly from their shareholder letter. What does packing a document like this really tell you, the listener?
Well, I think it really reveals the complexity, the multifaceted nature of a global firm like Goldman Sachs. You realize it's not just about the high-profile deals you read about or the trading desk. It's also deeply focused on technology, on building completely new consumer-facing businesses like Marcus was at the time, on nurturing talent pipelines, engaging in significant community investment, and, constantly trying to balance that drive for growth with rigorous risk management.
Yeah, it provides a much, much richer understanding than you typically get from just the headlines, doesn't it?
Precisely. It shows you the underlying strategic principles, the challenges they acknowledged, and the areas they believed were absolutely crucial for their long-term success at that specific moment in time.
Okay, so here's a final provocative thought for you to consider as we wrap up. The letter talks about that potential transition away from an intense period of regulatory increase towards maybe one of rationalization, while at the same time stressing the need to watch for potential excesses and manage risk as economic cycles mature. Now, thinking about those points from 2017 and looking at the financial world today,
Hmm.
how do you think major institutions like this navigate that constant tension? The tension between the absolute imperative to grow and generate returns and the fundamental need for cautious risk management in economies and regulatory landscapes that are always changing.
Yeah.
It's a critical balance, isn't it?
Yeah.
And this letter just offers a fascinating window into one firm's approach. They're thinking at one particular pivotal moment, something to mull over.